All right, another year has just passed. Extremely different year from the ones that we actually know. Of course, we had new things to learn, new behaviors to emulate, and commodities were no different. All right, what we had is a year where the starting of the year where nobody knows how to react to. Now we know how to manage things. All right, if you look at the screen itself, you see a tiny fly just over here been nipped by American, but it seems the commodity scene was actually nipped by China instead. Okay, let's go on. Before we always start is the usual disclaimer. That is, this presentation is for information only, and for further analysis and projections or forecast, you have to get back to other Lucas or myself. Okay, we'll start with a quick recap of commodities in the year that have just passed. That year was, I think, something that in our memory we will always remember. Right? It was marked by volatility, demand destruction, and then we had supply overhangs in commodity markets. And fear and hurt.
Yes. Sorry, yeah. Can you make your slides full screen? And I think you didn't change the slides to the quick recap.
Okay, let me see. Huh? Okay, you want a bigger screen, right? Okay. Oops. Okay, let me see what I can do. I can make it. Let me try now. Or is it still the same?
Yep,
huh?
Yep, it's good. It's good. You can.
It's good
proceed,
now
please.
because on my side I see still the same. All right. Okay. Thanks for highlighting that. Okay, I was saying 2020 was a difficult year, especially for economies closed up. Later on, it opened up again, and then some are still under lockdowns. Then we have commodities like gold, which hit all-time highs. Then after that, we had social distancing, massive central bank intervention, government pumping in a lot of money to the economy to get things done. We also had a change of habits. Okay, and this change of habit has brought about structural changes in economies and of course in commodities. But ironically, the greatest benefit of 2020 were not exactly what we say the brick and mortar economy, but the financial markets. But that's 2020, and going forward towards 2021, there are a number of analysts who feels that it will be a commodity year. Okay, then it's 2021. Actually, 2020 and with a bang, we had the weather phenomena La Niña, right, which has affected all agricultural crops that grown in the East Asia, especially Southeast Asia, South and North America. There's high risk of drought in South America that if it is the rains are not, or rather water collection is not properly managed, it will affect the corn and the soya crops. Then we have to understand the supply, demand and storage dynamics on a totally different level. Last year it was quite a bit in the agri economy. It was Trump, ex-President Trump against his fight with China. Right, this year we have Biden as the new president. Then we have to look at commodities from a different angle altogether. Then we also have more waves of the coronavirus with its variant mutations, right? With the rollout of vaccines, we thought that, okay, this is it, but the virus is actually a flu virus that mutates, and it has come on with different variations. And of course, in 2020, we will find that central bankers a bit more smarter after learning from hindsight, and then they will target, or rather have targeted measures for different dynamics this year. Let us look at all these factors and how it will affect the key commodities that was on the front page. Okay. Outlook. Okay, I want to just pay a little bit of attention to the little chart down there. It's how the commodity money has flowed in or out of it. Okay, ever since, if you look at it in November, it had started to grow and it is still growing. And you see, if November, this one is primarily about November 4th. Okay, what most analysts believe that this is the start of a commodity super cycle. Commodities have been ignored. Now with Biden's win, everybody is looking at commodities again. Why? Because we have Biden who is going green. He has a different oil policy. China has super targets for shutting down the amount of, or rather getting rid of the carbon in the air in China itself. Okay, if you look at the chart down there, it's, if I'll say this full steam ahead, because it's a linear curve, all right? This is what we projected earlier on, right? For China to grow, but China has surprised us, and this is the projected growth pattern towards 2024. But why China? China is, of course, a big grower of a number of crops. They have a lot of base metals, but they also have a huge consumer base, and they are a huge importer in number of commodities. They are number one in rubber. They're a huge importer of palm oil. In fact, no doubt they are a huge producer of crude oil, but they're also one of the largest importers of crude oil. Of course, in 2021, there will be a significant amount of growth in money supply. We'll continue to see rock bottom interest rates, and of course, fiscal policy will need to be continued. And of course, if we had paid attention to the recent Fed meeting where the Fed chair had reiterated that the US economy still needs to be looked at. It's not out of the doldrum itself. He's still concerned. Okay, when you look at commodities, what actually do you look at? Because as traders, we want to know, right? We have the big picture. We expect commodities to grow. But how do we actually go down to the micro drivers? Of course, you need to look at the global economic outlook. That's for sure. Then we have the traditional drivers that we actually look at. That is supply, demand, inventories, and weather. These are primarily the first things that we actually look at when we analyze any commodity. We look at the supply, how demand, these are the four things. But now we have new drivers. right? We had the lingering effect of COVID-19, low interest rates, a lot of money being flushed into the system, and of course, all this money has led to quite a bit of speculative interest. So far, the speculative interest has been mostly in the equity markets, but as we all know, equity markets are heavily overbought. Let's see where the money goes to from the equity markets after this, and most suspect that it will be into commodity markets. Just this week, the IMF report for January 2021 came out, and the IMF was a little bit more upbeat than the World Bank on the world economy. What they said was we have infections, restrictions will soften momentum in 2021. This one will pick up steam again in the second quarter. Right, we have vaccines, therapies. Problem is now the distribution of these vaccines where they're most needed. Then we have the supporting financial conditions. They're quite happy with it. And lastly, they said they will see rising commodity prices, reflecting projected global growth. They are projected at this year to grow at 5.5%, whereas last year from October they was a little bit lower at 5.2 for this year. Then they say because of the low base, we will see quite a bit of growth. Non-oil commodities are expected to accelerate higher, especially those metals. There are others that would be needed by consumers, which would also grow with the metals. These are the projected growth that they have highlighted. Okay, global economy, they said for 2021, 5.5% this year. Then the advanced economy is a little bit lower. And then we have emerging markets and developing economies, which they project at 6.3%. Okay, this we have the detailed projections. This we have covered. Okay, when you look at China, China is projected to grow this year at 8.1%, and India at 11.5%. But India is not a huge player in commodities because they're quite insular in quite a number of commodities. They do import quite a bit of palm oil and oil, but it's China that we want to look at. Okay, then we go on to how prices will go up. Because prices of commodities always move in a cycle, in a boom and bust cycle. And a lot of analysts have projected there is a start of a super cycle. What exactly is a super cycle? It's normally of a duration that is decades long and is above trend. That means you draw a trend line and you find prices moving above higher than that. And most importantly, it derived from a structural change in demand. And for example, we had the US coming out in the late 19th century and post-war construction in Europe and Japan. And the most recent example was the super cycle in the BRICS countries, Brazil, Russia, India, and China. But good things always come in. And the last super cycle at a full stop in 2009 because of the financial crisis. But only China made use of the financial crisis to develop its infrastructure and construction sectors. Others mostly were fighting fires, propping up banks, and ensuring that their financial system is intact. However, by the middle of the decade, even China had ran out a little bit of steam because they felt that the economy of China was heating up too fast. Okay, even funds have stayed out of commodities because of the abrupt change in 2009, but most of them now view commodities as having a V-shaped recovery, and they have a much longer structural bull market that is going to emerge from this. Okay, this chart is from Goldman Sachs, and it's the chart of the LME index of base metals. If you look at it, the year 2000, we had a bull run. All right, this is where all the BRICS countries developed. The consumers grew, the middle class grew, and in 2009 it came down. Then it picked up again, and here we are now, right? 2020, we had COVID, and after that, structural changes in economies. So the question we always ask is, are we in the beginning of a new commodity super cycle? Anyway, Goldman Sachs analysts certainly think so. And they're given their reasons why it is so. I've mentioned before, China is going for carbon neutrality by 2016, and the new American president will be returning to the Paris Agreement on climate change, decarbonization, and so forth. I mean, what this one it means is that there will be different demands for different commodities. And of course, green will be the new word. And of course, also plus policy focus on social need. And that's where the word ESG is getting high popularity these days. And boiling down lower, right? What we need is when countries go for different policies, they have to change their capital structure or how they spend their money. All right, and this one has the effect on the labor markets and commodity producing countries, especially if the money goes to the poorer sector of the economy, which tend to spend practically most of what they have, and that creates a huge demand. Okay, the key is often lack of supply. All right, we know that there's not because of COVID-19. There's not much investment has gone into commodity mines, into commodity estates, or commodity fields that produced all kind of crops. And on top of that, we had China soaking up stocks of metal, copper, aluminum, and iron ore. They felt that now it's metals, these commodities are cheaper, we'll buy and we will stock them. However, Goldman Sachs' view is not the gospel truth. Analysts have been, I would say, not totally correct number of times. Okay. And the thing we normally are concerned if the Chinese growth moderates, all right? And with the rest of the world trying to catch up, we will take some time for the super cycle to get started. Okay, let's now go on to specific commodities. Let's start with palm oil. Palm oil had a rough start last year. They had a whole range of problems. All right, we had oil crashed right down to below zero. Negative demand had plummeted. We had the high, what do you call, the palm oil gas oil spreads, which didn't actually favor palm oil. And of course, we had demand destruction with the lockdowns and a lot of other issues with COVID-19. Okay, palm oil long-term chart. If for those who are exactly not really familiar with palm oil, you find that over the years, palm oil spot market has been growing. We had a bull run because of weather issues early on in the year, rather the decade, and this is where we are now on the hindsight. Yet we feel that palm oil has done very well despite the issues that they have. Why? Okay. There were a number of reasons why. Because of all the issues that I highlighted earlier, we find that as the soybean market, which is the next best substitute for palm oil, had a number of issues, so did crude palm oil. Okay, going forward, we do expect this year to be a special year for crude palm oil. Despite growing in the second half of the year, we would have the palm oil to have a best year also, especially when the weather phenomenon La Niña will be in full swing. Okay, we already know about the floodings, and if for those Singaporeans, they'll remember that the rains came in late August, and which normally do appear in the November, and we have been seeing them until only recently. Yet we still see sporadic rain. And then we have other pressures, right? For example, recently we had the Chinese pig population growing, and that has created unexpected headwinds. Okay, and analysts in Singapore, especially Satya Warka, I like to quote him because I know him personally, and he is a renowned and respected analyst. He says that with lower production, lowest stockpiles in year, he does expect prices to stay elevated right until maybe the middle of February, and then eased off a little bit this year. Because normally around March onwards, we do have the peak production season. And then the Bloomberg survey have come up with a range in which most analysts expect palm oil to range this year, right from 3,650 ringgit, easing off to 3,400 in the second half because of the high production. So this quarter, we have already seen the market go down to 3,200 and then bounce up higher. So a lot of them are expecting to see the 4,000. Our other veteran analysts like Dora Ministry, he is a little bit more bullish. He says expect explosive price moves due to short-term events like the La Nina just popping up out of the being reported by the weatherman and other issues. Okay, what is this La Nina that have been taking out? It's a weather phenomena that affects quite a number of countries due to what you call that change of currents in the Pacific Ocean. South America is affected. Then we have this particular range where we have Indonesia and Malaysia, and also some parts of Africa. Okay, of course, we have a lot of issues in palm oil also because of COVID. Indonesia, if you're familiar with the B30 program, in which the petrol that is used in the, rather gasoline that is used to drive vehicles has 30% mixed of palm oil with 70% gasoline. Or that is going to be the swing factor, because the B30 program, especially in a huge country like Indonesia, is going to soak up huge amount of palm oil from the market. Something that was used for mostly for edible oil and a little bit of blending in Europe is now being used in Asian countries. So for palm oil to really rally right up and be sustained above 4,000, we need this B30 program to work. Of course, Malaysia is at B20. We will see soon maybe a rollout of B20, although no dates have been fixed. The other one is the headwind that may cause is the gas oil palm oil spread, which is almost at the highest in 20 years. This could work against palm oil if the B programs don't work or don't work effectively. Of course, we have other labor issues. Because of COVID, there's always problems of getting sufficient labor to harvest the crops that grow all year round. Then we have a real shortage where hiring of foreign workers would add to cost. And going forward, we will see that the coronavirus may still have an effect on palm oil, because this is something that analysts did not realize before. The amount of food demand that comes from hotels and restaurants. And if hotels and restaurants, especially in China and in the countries where we have a huge amount of the Chinese population, if they are put on huge restrictions or strong restrictions, then it will affect the demand of palm oil. The Malaysian King also declared a state of emergency in Malaysia, and it remains to be seen when it will all end. Okay, this chart is primarily about the growth of the large population of hogs in China itself. The reason why is palm oil as well as soybean oil will be affected, because China has been buying huge amount of soybeans, and most of the beans are crushed into meal and oil, and a lot of this meal goes into feeding of the pigs. Then there is the residue called as you know, the soya oil, which is one of the primary substitutes for palm oil. So you have more soya oil being used, they will use less palm oil. So this is something that going forward we have to consider. Okay, this chart, we have all the production figures at the end of the If you want the slides, you can get it from Lucas, but I want to highlight the figures that are lower down, the stocks to use ratio. This is the ratio how much stocks there are and how much is being used. It is one figure that most analysts actually use to see whether this particular market is in a bull or bear mood. For 2021, we see the same things as a forecast for 2019-2020 years. Okay, let's look at the price. Roughly, what we would expect is the price slowly. We had fears on the Chinese, a lot of rumors that as they come on, but as the rains came in South America, but otherwise we find that it's still a demand story. The Americans bought quite a bit of corn and from the US, and that sort of set the market up again. And we have palm oil following suit. Let's go on to the grains itself. The grains has been an asset class that has really been not looked at, because for years they have been moving sideways. Even this year we have corn, wheat, and soybeans moving sideways. Then right from the middle of the year, when they realized that China still needs to buy regardless of all the rhetoric that is in the air, and prices of the three major grains and oilseeds appreciated. This is a chart of I've used the May 2021 seaboard agricultural futures, and you'll find that all of them are making a good bull run. And going forth, the planting season is going to start in late March, and there's going to be a fight for acreage, in the sense that if a farmer plants corn, he will not be able to plant soybeans and even less wheat. So the farmer has to decide before planting whether he wants more corn and soybeans. This is normally done around the middle of May. Sorry, the middle of March. Okay, when we look at the agri-commodities in the US, we look at three main engines that would drive this market. We have, of course, the weather risk, especially from La Niña. The crop, once the crop grows, is planted in the ground, is at the mercy of the weather. Then we have good import demand from countries stockpiling grains and oilseeds. The COVID pandemic has shaken a lot of governments who thought that, all right, we can always depend on steady supply of grains and oilseeds and other commodities. You can always buy them in the market, but they realize that if everybody is buying at the same time, you'll get a very bad price. Okay, and then we have the speculators now taking a look at the market. Right, this is the chart of the Bloomberg Agri Index. It's primarily have 9 crop prices, and you'll find that right this year it has already grown about 38%. For those traders with smart money who realize that the market is going to boom given the structural changes, has been proven right by this chart itself. Then we have the La Niña. They affected a number of crops, especially the agri crops, because the winter wheat crop in the US grows is the wheat is planted in December, and then the snow covers it, and then when the snow thaws, the plant starts to grow. And of course, we have also wheat from Russia, Black Sea area, and we find that because of La Nina, it has hit quite a number of crops because the snow cover has not been deep enough. Okay, then we turned our attention to China. First thing is something that uncertain is how the two big nations, one a grower of agri products and the other one a huge importer, is going to interact with each other. China needs quite a big, or rather a huge amount of commodities. Okay, if you look at soybeans first, right, this is their domestic consumption and this is their domestic production. But for soybeans, we know, right, this has been like that for many years. But if you look at corn, recently you find that corn domestic consumption in China has grown, but its production has lagged. That's why recently the markets bounce, or the agri markets and the palm oil markets, because the news popped up that China has been buying big in the corn market. And why is China, despite being an agricultural country as well as a developing one, has poor yields? Their yields have been really lagging behind the US for some years, and for some reasons that I think in the lack of time we are not able to go through, we find that the yields in the US has been much better, and we had huge crops there over the years. It is the projection that the USDA, the Department of Agriculture, has made some years back, and they have projected that, all right, this is how the Chinese demand is going to grow. And they make similar projections in 2020, as China needs to buy, whether they buy from South America or they buy from the US. But as far as corn is concerned, US is the biggest producer, unlike soybeans, which are also produced in a large scale in South America. Okay, this is the outlook from the latest WASDE report. For those who are interested, they can go to the US website and take a look. But what I am interested is basically the US yields. I mentioned it before. And of course, this is the price that the farmers get at the farm gate. Over the years, beginning of the year, normally the prices are normally quite stable, but because the planting only starts around here over the years, and then we have volatility in the market. But this year, ever since September, prices have been going up. Okay, this we see a chart of corn futures monthly. What we have had is a number of years of corn developing a base just above the $3 a bushel mark. Then we had a spike as traders realized that, oops, all right, we need more corn than we can actually grow, or we have inventories to cater for it. Okay. This is 2007, the bull run. You find that from 2001, this is primarily the super cycle, and then we had prices going down, and then this year China started to buy again in stockpile, and this is where we were. All right, projections are that if the planting season is bad, the corn prices are going to shoot up. Okay, this is the soybean, primarily their outlook. We have huge uses of soybean. That's where we have front month demand, March 21, and then the November 21 contract. Because the soybeans for the new crop in November has not been planted yet, so we still see this particular month a little bit soft, whereas the front month demand is pretty strong. Of course, if you see projections from the watch day reports from the USDA websites, we find all kind of statistics that will indicate that soybeans need to push higher to cater for the increased demand. Okay, same thing, the stocks to use ratio for soybeans. You notice that this ratio pretty for this 2021 season is pretty low. Or this particular statistics is from the Oil World, renowned analyst for soybeans and other oilseeds. Okay, then we have the seaboard soybean futures. Okay, one thing to highlight here is that for agri, we do have such things as the new month and the old month. So if there is huge demand in the front months, traders need to know which contracts to short. And if the harvest is good, you need to know which contracts that is best for you to invest in. So your analyst, I think Lucas, will be able to advise you based on this. Okay, let's quickly go on to wheat. Same thing, we had the same problems with wheat itself, weather issues, tightening stocks have strengthened wheat markets. If you look at it, wheats have been the doldrums, and the Chicago wheat has started to appreciate. A little bit more on wheat itself, because wheat is grown throughout the world. It's not only US wheat, and it's not only the soft red wheat, we have the hard red wheat and many other varieties. So the wheat market has not been that unduly affected as compared with corn and soybeans. Okay, let's rush on to crude oil. Traders must remember, first thing when trading crude oil is that crude oil prices are driven by expectations and not by immediate realities. So if you trade at crude oil, and if you are investing in a slightly longer period, you have to look at expectations going forward rather than what's happening in the market today. Whatever factors, drivers there are, you need to analyze how they could affect markets down the road. Right, when you look at crude oil, we look at supply demand perception, and of course shale oil, which had been pretty dominant over the years but have lost a little bit of steam. Then we had to look at OPEC, how OPEC looks at the market, and then we had the COVID vaccines and the new virus mutations, which will affect the demand side of the crude oil, and how fiscal monetary packages would also determine how much money there is flushed and how much money that the speculators can get access to. Then we have new Libyan and Iranian oil exports that are coming into the market, and we have a new American president has a new American energy policy going, how going to affect the amount of oil that the US produces. Okay, on the supply side, we have the expectations is that OPEC wants higher prices of oil, but they do not want high price of oil to benefit the American companies alone that had happened in the before 2020, when OPEC tried to move the oil markets, and they realized that the key beneficiaries were the US energy companies who practically made use of the futures market to hedge their needs. And of course, when prices rise, they lock in their production and also make use of the fact that high prices and sell oil at a higher price. Okay, on the demand side, the most important thing would be to see how the coronavirus fare, because we are looking at demand down the road. If social distancing works, economies open up, the demand side of the story will push prices higher. Then we had the shale oil. Of course, given the high price at Brent above $50, we have all these drillers coming back, and the rigs have been the rigs that they actually use for drilling the oil have been rising for 9 weeks in a row. But if you look at the chart, it's still a long way to go for the rig count till it reaches the pre-March levels. Yet it can grow because all rigs are easy to to be brought back into production. Most of the time when they idle a rig, they don't just shut it completely, just minimize the production and reduce their cost. So these rigs can go on, and it remains to be seen how these drillers are going to come back. But I suspect that they have a tough time, especially banks are reluctant to lend. Then we have key expectations from OPEC and their partners. Previously, they used to meet something like maybe once a quarter, then it's once in 2 months, and now they made it a point to look at the market where all the ministers will meet, especially in the first week of the month, and decide, okay, this month what we want to do, right? Of course, last month was quite a surprise when, right, they said, okay, we taper production from 7.7 to 7.2. Then Saudi Arabia said, no, besides this, we will voluntarily cut output, and that's why we have prices that are very firm now. Because if demand is curtailed and the economy is coming out of the COVID-19, we have demand spike. Then we have Libyan and Iranian production. Of course, this is a lot of politics and the American policy on clean energy. But what we will see, we have already seen rather the cancel permit on the Keystone 11 pipeline. So going forth, I think the shale guys will not have as much leeway as previously under President Trump. Okay, this is a look at the NYMEX monthly futures. So this is where we are, almost $53 a barrel, right? And I would say touching right there, right? Maybe $60 is just $8 away. It's not too difficult, right? But we need to look at what happens when OPEC meets early next month and to reaffirm OPEC's intention of holding high prices. Let's go on to gold, and the things to look at for gold itself. Gold had a super run because with all the amount of stimulus that is coming into the market, we do have the markets being flushed with liquidity which of course will debase currencies and other asset classes. Okay, and central banks, right? Central banks growing the assets. There's a strong correlation between the amount of assets that central banks hold and the price of gold. And right from the year 2000, you see that as the assets grow, the gold price will also grow. All right. For those following the gold market, you roughly know that gold has been in the doldrums. All right, they have hit above 2000 and drop off after that for reasons that is primarily because, of course, markets get fatigued and speculators do want to look at other markets for the time being. Then we had Janet Yellen's testimony, the president's inauguration, and we find that the Democratic Senate has a majority which make it easier, if not impossible, for them to push through their agenda. And of course, we had a lot of volatility in the market because we had the Fed, one of the biggest Fed who felt that, okay, who mentioned something about tapering, and the market, of course, panic when after the last time when the Bernanke, or the ex-chair of the Fed, mentioned this. Okay, gold is actually primarily, if you want to boil it down, is primarily affected most by real interest rates. The real interest rates are primarily, you take the nominal interest rate, you minus the inflation rate, and you get real rates. So this is one of the main drivers that affect gold itself. If you look at this chart of, you'll find that it's the real rates that actually affect gold more than anybody. Okay, you have the US dollar next. And if you find the 5-year US Treasury rates, you find that it's the 10-year rates that affect the real rates that affect gold most. Of course, this is not the thing. It can explain, the rates can explain gold in the long run and quite a number of times in the short run. Okay, the dollar, no doubt we have a lot of hype in the gold reports about the dollar itself, but the dollar is not the key that will really give you a good analysis of the gold market, right? Primarily, it is more the US 10-year treasuries, right? That the yields that these treasuries have. If you find a gold with the dollar index, and here where we had the liquidation of the ETFs, but we still find the dollar indexed still in a different arena. Okay, the Fed drives real interest rates, and real interest rates drive gold. This chart is the chart of the long term from January 76 to January 18. Then, of course, we had the assets that the central banks hold. You find that a little bit of the news about tapering, the markets will react bearishly. Reason why is there is strong correlation with the amount of assets central banks hold versus the price of gold. Okay, gold outlook. Primarily what we feel is gold is still a very strong source of value. gold is not too difficult to look at. You need to monitor the long-term real interest rates, and you can get a hold of roughly what gold will do. And this year we do expect gold to perform well. Then we have the COMEX futures. My view, right, is that gold will appreciate. It will go up and test because there's a lot of liquidity in the market. Interest rates are low, and given a short-term event, gold will spike. But we may have a tough time going up to the previous highs of 2000, unless there is some other structural change with COVID-19 and the central bank start pumping in a lot of more money as they did in March last year. Or what time do we have? All right, maybe we have time for one or two questions.
Right, thank you, After. Let's see. Two questions, yeah? Okay, Mr. Gary is asking, is crude oil price will be bullish again like last time?
Yes, crude oil. All right, if you dig up a little bit of history, you realize that early on we have crude oil above $100 a barrel. It stayed between 80 to slightly above 80 to $100 a barrel for some time. Then it really dropped quite a bit. The primary reason was the shale producers were ill-disciplined. They really didn't want to manage the amount of oil that they pump out of the ground, and they kept pumping and inventories really swell above the 5-year average. Then OPEC said, okay, why are we letting them eat our cake? And prices fell off. But now you find that the shale producers are not, I would say they are not a swing factor so far now. And then we have also Russia, who is in the same wavelength as OPEC. So we have these supply factors. And on the demand side, I would say with our better management of COVID-19, things need to improve. Demand side will improve. Inventories are coming down also. We'll see prices go up, but we would not see $100 a barrel, maybe up to above the, if hopefully I'm right, $70 a barrel by the end of the year. Yeah, next question.
Okay. We have one more question. Given the fact that Federal Reserve will continue to keep the interest rate low, okay, for the foreseeable future, and more stimulus plan from the government, resulting in more inflation and money printing activities. Will this happen? What do you expect gold and silver, maybe the price target to be, if any?
Okay, we have the premises of excess liquidity in the market. The thing is always inflation. In 2009, we had the same thing, although not on a huge scale as we have it now. Inflation didn't exactly show its face. So by this time, the key thing is, will inflation come on? But as I have spoken about the commodity super cycle, right? Commodities, if we have a super cycle, chances are what we are saying is higher prices. And the key is often the base metals as well as the price of crude. If a lot of things depends on cheap availability of crude. If, let's say, crude trades above $60 a barrel, even for the WTI, right, we'll find that things are getting a bit more expensive. So we would have inflation. And gold is primarily also rather inflation is also positive for because of the formula rates. You have real rates, nominal interest rates minus inflation. So you have high inflation that will actually push down the real rates, and it's good for gold.
Okay, I guess that's all the time we have for today. Thank you all so much for being a wonderful audience for tonight's webinar. Thank you, Aftar, for the insightful speech and the talk with your very comprehensive slides. Okay, a link to this recording will be made available for our follow-up email tomorrow. If you have any queries on the webinar or would like to get started, simply reply to our email and we will get in touch with you. This is Lucas signing off. Have a good evening ahead.